This man is losing money, not much, a few dollars of water, 40 minutes of his Saturday, a sore back, and a windshield that, in 3 days, will be in exactly the same condition it was before he started. He is standing in a suburban driveway with a bucket, a sponge, and a garden hose, doing what people have done on Saturday mornings for 60 years. But 3 miles away, someone else is making money on the exact same operation. A lot of money. And so reliably, so predictably, so mechanically, that fund managers in Manhattan, in London, and in Dallas are now competing to buy the business you have driven past 1,000 times without once looking at it. A car wash. Over the last decade, something very strange has been happening in Western capitalism. Private equity firms, the investors who buy private companies using a great deal of debt and a great deal of ambition, started buying car washes. Not one or two, thousands of them. Leonard Green and partners bought Mr. Car Wash. Freeman Spogli backed Quick Quack. Windpoint Partners, Access Holdings, and a dozen other funds moved into the sector within a few years of each other. In 2021, Mr. Car Wash, the largest operator in the United States, went public and was valued in the billions of dollars. For soap, for foam brushes, for a thing you associate with the drive between the gas station and the grocery store. And this is a contradiction worth taking seriously, because private equity is not sentimental. It does not buy things because they are charming or local or because they create jobs. In fact, as we are about to see, rather the opposite. Private equity buys because it has spotted something the rest of the market did not. So here is the thesis of this video, and I will state it now, without ceremony. A modern car wash is not a vehicle maintenance business. It is a rent extraction device. It is a hybrid financial object that combines 3 things investors love. Recurring subscription revenue with the profile of a software company, a cost structure so thin it barely exists, and a piece of real estate sitting on the best corner in town, all of it wrapped in one of the most efficient legal tax shelters available anywhere in the American economy. Washing the car in this arrangement is almost a pretext. And to understand how we got here, you have to start with the only innovation that genuinely changed this industry. It is not mechanical, it is not chemical, it is psychological. For 60 years, the car wash was a miserable business. Miserable for one simple reason. It was transactional. You sold a wash, you collected $8, and then you waited. You waited for the next customer. And above all, you waited on the sky, because this business had an unofficial majority shareholder, the weather. 3 rainy weeks in November and your revenue collapsed by 40%. A mild, dry winter, and you were rich. It was seasonal, cyclical, and violently unpredictable, which is precisely the risk profile institutional investors refuse to finance, because you cannot underwrite bank debt against a high-pressure system. And then, around the early 2010s, somebody had an idea of almost insulting simplicity. What if, instead of selling washes, we sold a subscription? The Unlimited Wash Club, $20 to $40 a month. And for that, you wash your car as many times as you want. Every single day, if you feel like it. Say that sentence to a consumer, and he immediately runs a calculation in his head. A single wash costs $20. The membership costs $25. So from 2 washes a month, I am winning, and I wash my car at least once a week. Except, no. You do not wash your car once a week. Nobody does. Usage data from the large operators tells a considerably more humbling story. The average car wash member shows up somewhere between 1.5 and 2.5 times a month. And a meaningful share of members, at some locations roughly 1 in 5, simply never comes at all for months on end while continuing to pay. Behavioral economists call this optimism bias about future usage. We never buy a subscription for the person we are. We buy it for the person we intend to become. The man whose car is always clean. The woman who goes to the gym 4 times a week. The reader who is finally going to use that newspaper subscription. And the second bias is even more powerful. Inertia. Canceling $25 a month requires effort. Finding the email, remembering the password, clicking through 3 screens designed by people who are paid to make that experience unpleasant. $25 is precisely the number that sits below the threshold of annoyance, small enough to ignore on a bank statement, large enough to build an empire on. This is the gym model. This is the Netflix model. But with one decisive advantage for the car wash, and I want you to hold on to this one because it is the heart of the entire story. A gym quietly fears its most dedicated members because they occupy the machines and wear out the equipment. Netflix pays billions in content costs to retain its own subscribers. A car wash does not care at all, because if a member shows up 6 times a month instead of 2, he costs it a few extra dollars. And that is exactly what we are going to take apart next. The effect of this shift has been dramatic. At the large American operators, members now account for the overwhelming majority of washes, frequently more than 70% of total volume. Revenue is no longer a meteorological sawtooth. It is a straight line, and a straight line, in finance, has a name. It is called a higher valuation multiple. We will come back to that. So let us go inside the tunnel, literally. A modern express tunnel runs about 100 to 150 feet. The car is pulled along a conveyor rail, the driver stays behind the wheel, and the whole thing takes 3 to 5 minutes from entry to blowers. A well-located site processes somewhere between 8 and 12,000 vehicles a month. The best ones clear 20,000. Now, the question nobody ever asks. What does a wash actually cost the person selling it? Line 1. Chemistry. Alkaline detergents, drying agents, carnauba sealant, wheel cleaner. These arrive as 5-gallon drums of ultra concentrate and are metered out by the milliliter through computer-controlled pumps in the equipment room. Real cost per vehicle, 20 to 50 cents. Line 2. Water. A tunnel wash moves somewhere between 30 and 40 gallons of water in total. But, and this is the crucial part, only a fraction of that is fresh water from the municipal supply. Cost, 10 to 30 cents. Line 3. Electricity. Brush motors, high-pressure pumps, and above all, the drying blowers at the end of the tunnel, which are by a wide margin the most power-hungry element in the chain. 30 to 60 cents, depending on local rates. Do the arithmetic, total variable cost, somewhere between 75 cents and $1.50. Retail price, $15 to $25. On a premium wash sold at $20, gross margin, what is left after paying for everything you consume to deliver the service, sits between 85 and 92%. 90% gross margin. That is the profile of a software business. A restaurant fights to reach 30, a grocery store, 25. Except here, there are no engineers on $150,000 a year. There is foam, and there is tap water. And water deserves a closer look, because that is where a double optimization happens. Economic and regulatory at the same time. Modern sites reclaim their water. The principle is straightforward. Water running off the vehicle is captured in a series of buried settling tanks, where solids and hydrocarbons separate out, then pass through sand filters or biological treatment, and return to the front of the tunnel for the early stages of the wash. The stages that do not require perfectly clear water. Only the final rinse uses fresh water, usually reverse osmosis treated to prevent spotting. The result, 60 to 80% of the water is reused, which means a professional tunnel wash consumes less fresh water, often 3 to 5 times less, than the man at the top of this video with his garden hose. And here, something very interesting happens on the regulatory side. When a region enters drought restrictions, authorities ban residential vehicle washing, dry riverbeds, water use notices, emergency ordinances. But those ordinances very often carve out an exemption for commercial facilities equipped with water reclamation systems. Take a moment to register what just happened. An environmental restriction designed to reduce water consumption has just eliminated the entire free competition in the sector. The primary competitor of a car wash is not the car wash across the street. It is your own driveway, and a drought makes it illegal. So the investment in water reclamation, a few tens of thousands of dollars, is not merely a cost saving. It is the purchase of a license to operate during a crisis. It is a regulatory moat. That leaves the final cost line, the one that kills most neighborhood businesses. Payroll. A modern express tunnel operates with 2 to 4 people on site. Not 30, 2 to 4. 1 or 2 guides at the entry to line the wheels up on the rail, 1 person on maintenance, and that is it, because everything else has been automated, and it is worth spelling out how. because this is where the sector's real technical revolution happened. First, license plate recognition. A camera mounted above the entry lane reads your plate on approach. The database matches your membership. The gate arm rises. No human contact, no card, no code. The trip from street to tunnel takes seconds, which mechanically raises the site's throughput per hour. Second, the self-service kiosks, which replace the cashier and, this matters, are designed to sell. The screen systematically offers you the higher package, then offers the membership by framing the price gap as trivial. It is algorithmic upselling applied to soap. Third, the autonomous conveyor and the profiling sensors, which adapt brush travel to the shape of each vehicle without anyone intervening. Add it all up. After paying for chemistry, water, power, labor, maintenance, and rent, a well-run site generates between 35 and 45% operating margin. Some clear 50%. For scale, a restaurant fights to reach 10%, a convenience store 3 to 5%. And yet, everything I have just described, the margins, the subscription, the automation, still does not explain why Wall Street cares. Because the real move is not in the operations. It is on the balance sheet. Look at where car washes get built. Always a corner lot, always a high-traffic arterial, always beside a strip mall, a gas station, a big box grocery store, always with clear sightlines from the road and an easy turn in. These are, without exception, the most expensive and most contested parcels in a town, which should raise an obvious question. Why would a business with such low perceived value pay for the most expensive dirt in the city? The answer: the land is not a cost. The land is the product. Here is how the real estate play works. An investor buys a corner lot. He builds a tunnel wash on it. In the United States, the fully loaded project, land included, typically runs $4 to $7 million. Then he operates. And while the operation runs, two things happen at once. On one side, the cash flow from washing cars pays down the loan that bought the land. On the other, the land itself appreciates year after year, entirely independent of anything happening on top of it. Put plainly, the customers buy the investor's real estate for him. And in 15 or 20 years, once the fields around it have turned into subdivisions, and the subdivisions have turned into apartment blocks, the investor owns a corner parcel in the middle of town, one he never really paid for out of pocket. And there is an even more elegant way to run the play. The sale leaseback. The operator builds the site, then sells the land and the building to a specialist real estate investment trust, while simultaneously signing a long-term triple net lease to keep operating it. He recovers the trapped capital, frequently several years' worth of earnings, and rolls it straight into building the next site. He builds at a 12 to 15% yield on cost, sells the real estate at a 6% capitalization rate, and pockets the spread. Real estate stops being an anchor and becomes growth fuel. But all of this is still ordinary real estate. The genuinely remarkable part, the part that turned this sector into a magnet for capital, is tax. You need one accounting principle first. When you construct a building, the Internal Revenue Service considers that it wears out slowly. A commercial building depreciates over 39 years, so you can only deduct 1/39 of its cost per year. That is slow, and from a tax standpoint, it is close to useless. But a tunnel wash is not really a building. Pull it apart in your head. The conveyor rail, the arches, the brushes, the pumps, the reclamation tanks, the lighting, the concrete pad, the landscaping, the signage, the payment kiosks. It is a machine with a roof over it, and a machine depreciates far faster. Over 5, 7, or 15 years, depending on the component. This is where a practice called a cost segregation study comes in. Engineering-trained tax specialists take the project apart line by line and reclassify each element into the shortest depreciation schedule the law allows. In a tunnel wash, the proportion of total project costs that can be reclassified into short-life property is exceptionally high, far higher than in an office building or a warehouse, which is precisely what made this asset so popular with wealth advisory firms. And layered on top of that reclassification sits the most powerful mechanism in the American tax code: bonus depreciation. It allows eligible short-life property to be deducted not in fractions over time, but as a massive share of cost in year one. At its maximum, 100% immediately. That rate has moved around, full through 2022, then stepped down starting in 2023, before being restored to 100% by the tax legislation enacted in the summer of 2025. Concretely, here is what that produces. An investor builds a site for $6 million. After cost segregation, say $3.5 million is reclassified as short-life property. With bonus depreciation at 100%, he can deduct that $3.5 million from taxable income in the very first year of operation. So the site earns, let us say, $900,000 of operating income against a depreciation line of $3.5 million. Taxable income, negative $2,600,000. Look carefully at what just happened. The site makes money. It throws off positive cash flow. The bank gets paid. Distributions go out to investors. And on paper, for tax purposes, it lost $2.6 million. That paper loss does not sit in a drawer. Depending on the legal structure and the investor's status, it can offset taxable income earned somewhere else entirely. A surgeon, a real estate developer, an entrepreneur who just sold his company, all of them are hunting for tax losses. Car washes manufacture them industrially while paying out cash. It is that combination, an asset that distributes cash while generating a tax loss, that explains why, between 2021 and 2023, a wave of syndication deals poured into this sector. Those investors were not being sold car washes, they were being sold a tax shelter with foam brushes attached. There is one layer left, the most lucrative of all, and it belongs exclusively to private equity. The car wash market is extraordinarily fragmented, roughly 60,000 locations across the United States. The 10 largest chains combined control less than 10% of them. The rest are owned by independents, families, retirees, operators running one or two tunnels. And when you buy a company owned by a single family, with a single site, no finance function, no national brand, you pay a low multiple, typically 4 to 6 times operating earnings, because it is risky, illiquid, and dependent on one person showing up every morning. This is called a roll-up. The fund buys 10, 50, 200 independent sites, each at 4 or 5 times earnings. It repaints them in the same colors. It installs the same software, the same plate recognition cameras, the same kiosks. It renegotiates chemical supply at the group level. And above all, it converts each site's walk-up customers into monthly members. And here, the alchemy happens. Because the consolidated entity is no longer valued as 50 small businesses. It is valued as a national platform, a single brand, contractual recurring revenue, a metrics dashboard, professional management, a demonstrated ability to expand into new markets. And a platform like that does not trade at 4 or 5 times earnings. It trades at 12, 15, sometimes 18, because at that point, analysts have stopped comparing it to car washes. They are comparing it to subscription businesses, to recurring revenue services, almost to software. The fund invented nothing. It did not improve the soap. It did not make the cars cleaner. It bought the same cash flow at one price and sold it at another, simply by changing the mental category the buyer files it under. In finance, this is called multiple arbitrage. It is entirely legal, it is the central mechanism of modern private equity, and it is by a wide margin the most profitable part of this whole story. Except that a mechanism this elegant always attracts too many people. Drive down almost any commercial strip in Texas or Arizona, and you will find 3 brand new car washes within 1.5 miles of each other, all built in the last 3 years, all engineered to capture exactly the same vehicles, all half empty. That is the first wall. When an industry posts 40% operating margins on a replicable template, capital floods in, and capital does not stop at the right moment. It never stops at the right moment. Between 2019 and 2023, the United States went through what the trade press eventually started calling the car wash arms race. Thousands of tunnels built into markets that, in parts of the Sun Belt, plainly could not absorb them all. The structural problem is this. A wash site's customer base is almost entirely local. Nobody drives 10 minutes out of their way to wash a car. The catchment radius is a few minutes of travel time, which means every new site built nearby does not create demand. It slices the same demand into smaller pieces, and a tunnel running 4,000 cars a month instead of 10,000 does not earn 40% less. It potentially earns nothing at all, because this model rests on very high fixed costs, the debt, the land, the maintenance, the overhead, against minuscule variable costs. That is extreme operating leverage. It magnifies volume, increases beautifully, and it magnifies volume, declines just as brutally. The second wall is the cost of money. This entire industry was built on one assumption, that you can borrow cheaply. The typical structure, whether it is a fund acquiring a platform or an independent financing a tunnel with a small business administration loan, leans heavily on debt. When your borrowing rate is 4%, an asset yielding 12% on cost is a mathematical certainty. When that rate goes to 8 or 9, the spread compresses and the certainty evaporates. The tightening cycle of 2022 and 2023 did exactly that. It made construction more expensive, it made acquisitions more expensive, and most importantly, it compressed exit multiples, meaning the price at which funds had planned to sell. Merger and acquisition activity slowed markedly. Public operators saw their valuations deflate from the 2021 highs, and some diversified groups began stepping back from their car wash divisions entirely. Leverage, it is worth remembering, is not a strategy, it is an amplifier. It does not make a good asset better. It makes a good asset spectacular and a mediocre one insolvent. And then there is the third wall, the most intimate one. This whole model rests on a psychological bet that you will not cancel, that $25 a month will stay beneath your threshold of attention. But when inflation eats into household budgets, people do something entirely rational. They open their banking app and they hunt for recurring charges. And in the hierarchy of a strained household spending, the car wash membership is not near the top of the list. It is in fact an ideal candidate for the axe, non-essential, easily substituted with a garden hose, and carrying no exit cost whatsoever. Churn is the Achilles heel of this model. It is already structurally high. Operators live with several percent of their members canceling every single month, which means a substantial share of the base has to be won back every year just to stand still. It only takes a few points of drift for that beautiful straight revenue line to start bending again. And the operator's standard response, raise prices to compensate, has the unfortunate property of accelerating precisely the thing it claims to fix. So let us come back to our man and his bucket. He does not know he is competing with an investment fund. He does not know that the corner lot he passes every morning was selected by a traffic flow algorithm, financed with structured debt, optimized through a cost segregation study, and is intended to be sold in 5 years at a multiple 2 or 3 times what it was bought for. He thinks there is a car wash on the corner. And that may be the most interesting lesson here, because it reaches far beyond washing cars. Contemporary capitalism has stopped looking for extraordinary products. It looks for structures. It looks for ordinary, boring, invisible businesses, whose uncertain revenue can be converted into contractual flows, whose labor can be automated until it disappears, whose operations can be strapped to a piece of land that appreciates on its own, and from which a tax advantage can be extracted that exists independently of actual economic performance. Recurrence, automation, real estate, tax. That is not a recipe for washing cars. That is a recipe for turning almost any neighborhood business into a financial instrument. And it has already been applied to veterinary clinics, dental practices, auto repair shops, gyms, daycare centers, nursing homes, and recreational vehicle parks. The car wash is not an anomaly. It is a textbook case. It is simply the purest, barest, easiest version to dissect. Because here there is no innovation narrative to muddy the reading, no breakthrough technology, no mission statement, no storytelling, just water, soap, and remarkably well executed financial engineering. The next time you drive past one, at night, glowing on its corner with the conveyor cycling and nothing on it, you will not see a car wash. You will see it for what it actually is. An asset. Thanks for watching. If you want more breakdowns of how ordinary businesses get quietly turned into financial instruments, subscribe, and I will see you in the next one.